what I try to tell the farmers is, first of all, we have to explain what is the environment farmers are operating within. And I think there's some pretty big central themes that are affecting the market. Obviously, what we're asking ourselves is the battle between the role of government. Is it going to be big government or small government? How is this going to proceed? And I think it has a tremendous impact on how the deficit. I am in the camp that basically you can increase tax revenues to a point, but there's only so far you can increase tax or the drag on the economy will be too severe. I would also argue that you can only cut so much spending politically. So it'll be a token break in spending, but what they're trying to do is cut the growth rate of spending. I don't think there'll be any real cutting of spending. Although sequester is coming up, I think they'll get that resolved because of the political hangover will be very bad for the current incumbent. So the only avenue really left to them is try to get growth back into the economy and or inflation or monetizing it. And we know we're currently on a monetizing game, and I think that's going to continue. My concern about getting a lot of growth back into the economy is that we have another big issue that started. I'm a very strong advocate of long-term cycle patterns. I think cycles exist in both nature and in economies. In our current cycle, we're working really started after World War II at the start in the World War II, and which created the baby boomers, which became the economic engine that propelled us to the significant highs that we made. It topped in the year 2008, but that was a structural high of this economic cycle. Now, over the next 25, 30 years, a lot of these baby boomers are going out of the wage earning market, are going to be getting money from their returns on their 401ks, but they're not going to be wage earners, but they're going to be consumers of services. And that's going to put tremendous pressure on the government because the services are going to increase. People are increasingly moving in urban areas, which increases services in government. But the consumption engine that basically has generated our economy is questionable. How effectively can you create that same consumption? So I think there's a real problem of revenue. And this is the imbalance that I think we're facing, is the revenue is not going to keep pace with consumption, and the net result will be inflation. Now that's good to a point for farmers. Inflation is good because it drives up land values. But there's a point when that bubble gets too big, it's going to be pricked. And that was probably one of the concerns I heard running through the crowd is this bubble got too big, is it going to deflate? And recently, I can go into a lot of detail. We went into a lot of detail differences. But the thing that's really caught the market's attention is USDA's recent announcement of the baseline 10-year price projections. This has really I think more than any year I've seen in a long time, USDA has really got a lot of play here, and it's just a projection by by the USDA Ag Economist, but their assumption is that yields will basically move back up. And when you look at the last several years, agriculture has been benefited by several factors that drove corn values to record highs. It's been benefited by the expansion of ethanol. We've had unprecedented demand in ethanol growth, even though livestock usage is constant. We've lost exports, but the overall demand has been fantastic for the last several years. So the demand growth in China is expanding. So China demand growth at the same time was getting domestic ethanol expansion. And we've had, since really 96, when you look at the 10-year deviation on trend, corn has actually had the last 3 years have been significantly deficient in yields. So we've had yield deficiency domestically, so global supplies have been tightened globally at a time when usage has been increasing, causing these significant prices. Now USDA in their baseline projections are projecting for 2013 the supply of production acres are going to go up. To 96, I personally believe it will be closer to 98, 99. Trend yields will go up. They got a figure of 164 factor, and I think that's a little hardcore. I think it'll be more like 158. But the problem is world competitors. South America is expanding their production of corn and beans and will be the largest exporter over the next 10 years of corn and beans, far outweighing our ability. So there's going to be an increase in supply in South America. There's going to be an increase in Brazil, in South Africa, and there's going to be expansion in the Black Sea and the Baltic states. So supply is going to be created on a global basis. So if we have an adequate trendline yield, we have the potential. USDA is saying, this is in their baseline projections released this week, says that we had a $7 plus average trendline yield average in 2012. They're saying by 2014 the trendline average would be $4.10. they are saying, is about as loud as they can say, that that you will have cash corn values in the mid $3 levels in central Illinois. And the impact of that is, with corn right now, farmers are telling me for 2013, with the high cash rents, the high input costs, their cost reduction for all costs, including land costs, is close to $5.50 plus on a good average 175 corn yield. They're saying that $5.50 is what they have to have FOB the farm. USDA is saying about as loud as they can yell, guys, if we have trend line yields by the fall of 2014, we're going to be below the cost of production. Everett farmers are going to be losing money. That's a wake-up call, and I think that's what's waking the market up. The market, at the same time, you're seeing general you're seeing liquidation of the trading funds, less becoming involved in the commodity sector, and going back to the equities. So the storm clouds are looming. It's now coming down to weather. If weather's average and global producers continue to expand, but China continues to use, the demand will not outpace the supply, and we'll get a period to excess production, which will lead to prices into a lower price structure that would be very disappointing. Now, that is, the other side of the pillow is that's very good for the end users, for the livestock boys. I would argue livestock producers every fall from September to October time period should be really thinking about buying their feed needs every year very aggressively, and probably the fall of 2014 be thinking very aggressively about a multi-year feed buying campaign. That's for every bull market, we sow seeds of bear market, and every bear market does sow the seeds of the bull market. You could argue that if we would get corn values at or below the cost of production over the next two market, you'll develop a tremendous demand base, which will then dovetail with government's need to inflate to keep their economy. So now you have inflation built into the market, and a tremendous demand base, and because farmers are losing money, they'll cut acres. You can set the scenario that every year, every spring, you have the threat of making new highs in the corn market. So the market is saying to me, is about as loud as it can say, is that we are going to have violent swinging markets as far in the future as you can see. And therefore, taking crop insurance, I think, is a very desirable attribute to lock in your production. You want to sell in such a way that you have flexibility, that if you have a weather event, you don't get killed on margin calls, which means that's more of a put philosophy. I don't want to sell cash because I don't want to sell, I don't know if I have the inventory until I get into later summer. You're going to have grain bins to store. I think having bins on the farm, be able to store it and know how to take advantage of basis gains is a very element. But violence in the future is now a way of life, and it's going to, I don't think it's going to get any worse. It's going to get worse. If as bad as it's been in the future, it's not going to get any, it's not going to be calm. And therefore, you're going to have to plan your game plan and figure out how you're going to take advantage of those programs. And that's what I work with farmers helping to do. You know, the livestock guys are scared why the market's broke here recently. They're a little surprised. But I pick sense that the cattle market is going to be very good for this year. I wasn't a lot of questions because there's not a lot of cattle guys around. I guess the big issue is I am not surprised by the questions after the meeting that I got is what do I do with my corn in the bin that I haven't priced? This is the recurring biggest problem I see developing on the forefront is guys that sowed early yesterday, last year in the April-May because a good spring planting was so fantastic. You know, after Louisville Farm Show, we pretty much sowed off all the way into June as the crop got better. And guys sold it in that April spring at $556, thinking the market was going to go to $354 with a big crop, and we had the crop disaster. And then they end up having no yield and crop sold. So now the guys are, I sense, trapped. They had, one guy said at $7.80 off the combine, today it's $7. They're 80 cents underwater on their selling price plus their storage costs. So you could say they're probably $1 underneath their fall price. I, in my 35 plus years in the market, I have yet to meet the farm market that can sell $1 a hit. And so I think we're going to have the real danger I see developing is if we have decent spring planting, we don't have any weather scare, and we have an okay summer. Well, there'll be some weather in the western corn belt, some stress, but overall the corn progresses, and you'll see the market trending lower pretty much through that time period. with limited bounces, and so guys don't sell their old crop corn, and they get stuck. And then it's all of a sudden it's August and they dump, or they'll maybe say, oh, I'll hold back 10-15% and mix it with new crop. And so all of a sudden and this perpetuates itself. This is what opens up, caused the potential of 2014 that USDA is suggesting the stocks will build, demand will be good, but it won't be enough to offset the short-term stocks. So my suggestion to farmers is don't let yourself get caught. Look at the clock, look at the time, and basically start making some hard sales as you get into April, May. Do not let yourself get sucked in hoping for it to get bailed out. And this strategy, in the last 3 years, they've been bailed out by putting the bin and storing it next year. But I think you now got to start forcing yourself into a disciplined scale-up selling program in 2013, or face the consequences. It might be a rough next 15, 18 months. Nobody has a really robust outlook of the general economy. Agriculture, everybody's positive, but the non-farm population outlook is, I think there's a lot of anxiety, and I can give you nothing to ease that. I think there is a lot of anxiety.